Hey everybody, it's Larry Berman here. November's over. A lot of thanks to give this week. Thanks to friends and family, and um, it's just as we head into the holiday season. I think it's the time of year, to reflect and be grateful, and reach out to people that maybe you don't talk to all the time, or maybe that you talk to a lot, or maybe that you had a bit of a thing with recently, and just kind of you know, make amends. And so, spend some time this week thinking about the year and what went really well, and what's yet to come. And I for me and my family, and my just celebrated my grandson's 3-year birthday this week. So much more to look forward to as we build Q Wealth, add great partners across the country. It's really exciting for us. The biggest thing for me, of course, is always figuring out investment problems, and helping clients, advisors, BNN viewers, um, you know, try to navigate the uncertain times. I mean, it's no surprise to anybody. The markets are crazy expensive here, and what do we do about it? When does the market care? Um, and boy, if I knew the answer to all that, I probably have a national TV show. Anyways, so let's take a dive into the chart room here. I don't have a lot to unpack this week, but we did learn a few things. So let's see what they are. So on the interest rate side, in recent weeks, we're talking about, being very, very bearish on rates, yields going higher. And, we saw some positive commentary after Trump nominated the Treasury Secretary Bessent. And, he's a bit less hawkish on tariffs. And so, generally speaking, markets took that positively. But it's more about short-term supply and demand than anything else. But with the recent backup in yields, the 30-year auction a few weeks ago was taken down massively. It was the best demand we've seen for long paper in a long time. So, the buyers of that auction were people worried about a weakening economic outlook, no doubt, and to have that duration on the portfolio, to hedge at some point for equities. So this week was the biggest week we've ever had in the Canadian ETF space in Canada in terms of asset allocation. And you saw it very much two ways. You saw huge institutional flow raising cash and getting more defensive. And you also saw a huge institutional flow, rebalancing and getting more aggressive. So you've got a lot of mixed views about what is in store for 2025. And I think as I think about the future and beyond, I'm going to start having some weekly guests on the show, and really maybe broaden out the YouTube channel. So we'll see how that all plays out, going forward. But the long bond is the best discounting mechanism for markets, and I just don't see it rallying. But when you look at the chart here on U.S. 30-year yields and where we went out at the end of November, you can make a bit of a bull case where it could rally back to, say, the 424 and a quarter level pretty easily. And so, when I was adding a lot of duration to portfolios in here as we were backing up, it's now paying off. Our bond fund had a very, very good month. But if you look at, where long yields were at the beginning of the month, and you look at, year to date, and so again, you can go back to here and see where we are now. Bond funds are not having a good year. In fact, another bad year across the board. So, it matters. I get a lot of questions on fixed income. Here's the biggest challenge that I see. So this came out this week too. This is the Fed's favorite measure of inflation. It's called the core personal consumption expenditure, and came in as expected. If you look at the details, slightly higher. And then they start calculating this thing that they call a super core. And I think Powell mentioned that, a couple years ago, that they look at this and they take components out of the PCR that are stickier. Okay, things that are going to be more persistent, services, more linked to wages than capital goods, where whether they're durable goods or not, they're products, and generally the price swings a little bit more on those. So you started now in the last 6 months. You've seen this overall services inflation flat line from the decline of the last few years, and now you've seen this super core kind of turn higher here. And so this is going to matter. But in November, celebrating the Trump red sweep, markets don't care. So when are they going to start to care about this? The answer is I don't know. Scott Bessent, who's going to take over Treasury on the 20th of the inauguration day. A week after that is the next quarterly refunding that he'll be responsible for in terms of positioning. And there was a narrative as yields were rising in recent months that if Trump wins, they're going to blame it on the Democrats and they're going to turn up the issuance of coupons. And so we'll see how all that goes. But that's the next big inflection point. When we look at the supply and demand story and we say, okay, well, what's coming this week? All you see is funding of treasury bills. And so there's no supply this week. You roll the calendar, and I don't have it here, but you roll the calendar to the next week, and now all of a sudden you got long bonds again. So we could see the bond market stay firm into the first week, but once supply comes again, are those same buyers that were massive interest at 460, are they going to have the same interest at 4.25 or 430, right? So that will be a key test for the bond market in the long end. And that will matter at some point for equity markets. Again, seasonality, everything you hear coming out of the street now is positive. I've heard all the bears turn positive. I haven't heard anybody really expressing any concerns about earnings growth or economic growth or even inflation for next year. Of all the strategist updates that have come out so far with their 2025, and beyond forecasts. So, the big move obviously in the month came on election day. And if you look at a day or two after election day and what happened the rest of the month, it was consolidation. It was wheel spinning, with the exception of small caps that saw a bit more in terms of gains. I always look at quality of small caps. So I look at the S&P 600 and I compare it to the Russell 2000. The bottom half of the Russell 2000, those companies basically don't make any money. They have negative EBITDA and earnings. And so, is this a quality rally or a junky rally? And the top 600 of the small caps are more profitable, more growing companies that will graduate into the S&P 400 mid cap. And if they keep going, will graduate into the S&P 500 someday as they grow. And so for the month, basically small caps overall, no matter if they made money or if they were good quality names, basically had the same month. When we look at the equal weight S&P 500, it's our yellow line. The average stock in the month performed a little bit better than the large cap weighted, performed a little bit better than tech, but all had very, very good months. And so again, broad-based rally led by small and mid cap, average stock doing better. So that's a big positive in terms of what we learned post-Trump. The America First agenda is better for domestic focused revenue companies versus international. Tariffs are coming. What we learned during the first Trump administration as well was that he plays the media. He'll have people, all parties do this, but Trump does this better than anyone else where, something's selling off. He'll get somebody or himself to tweet something to change it. We saw this a lot during COVID where, he would say, "Oh, vaccines are going to be ready any day now," and the market would shoot higher, and you'd have. So I think you can expect a lot of that in December and into January as we look at and think about transition. Biden is doing some of the things that he doesn't think Trump will, that he feels that if he can get them implemented now, they'd be stickier, it'd be hard to remove. So there's a bit of that going on. Be hard to see a major sell-off before the end of the year at this point. Why would someone want to trigger capital gains this year if they can defer them to next? Those kind of things play out. It's part of the seasonality. But we've had a lot of the move already post-election, and I would suspect that December is flattish to down from where we are now on equities. But at this point, I don't fear a big, major correction until we actually start to see the impact on companies and what companies are saying. If we get a couple more months of core inflation, going back to this, again, it takes time. If we see this kind of tick up here, that's when equity markets are going to have trouble. Initial claims this week, very benign. Labor market's relatively strong. It's not as strong as it was a few years ago, but all those things do support equity prices. They don't necessarily support the multiple that we're seeing. Anyways, that's all we have this week. Have a great week, everybody. Start to enjoy the holiday season. I will be spending the winter months in Florida for the most part, and we'll be doing my BNN shows remote from the beach, so to speak. Anyways, have a great one, everyone.